I want a piece of capital that produces money, because at the end of with this end game, I don't think we're going to go back into fiat. I don't think it's going to be possible. We're going to have to deal in gold and silver for as long as it's going to take to rebuild trust in some kind of credit derivative of gold and silver. But it's not like people are going to immediately go back to paper, because like, look what just happened. It's going to take a long time. And in that time, you're going to want to have companies that can produce gold and silver and pay you dividends in the money that's going to be for the world.
JPMorgan Private Bank. Gold is expected to continue reaching new highs with a mid-2026 price outlook of $4,050 to $4,150 per ounce. According to Zhitong Finance APP, Chen Weiheng, global investment strategist at JPMorgan Private Bank, stated that the outlook for gold prices by mid-2026 is $4,050 to $4,150. It is expected that gold will continue to reach new highs in the future. Chen Weiheng noted that although Federal Reserve Chair Jerome Powell's remarks did not provide a clear timetable for future interest rate cuts, the bank still anticipates that the Fed will continue to cut rates if the U.S. economic conditions weaken further. Gold typically performs better in a low interest rate environment because lower yields reduce the opportunity cost of holding non-interest-bearing metals. With gold's recent rise, investors may consider gaining better entry points through structured products. Previously, Federal Reserve Chair Jerome Powell stated that the current policy stance is moderately tight, allowing the Fed flexibility to respond to economic needs. However, Powell also pointed out that potential deterioration in inflation and employment could bring two-way risks, and there is no risk-free path for the interest rate outlook. The remarks of other Fed officials were not entirely consistent with Powell's. Goolsbee of Chicago believes that although the neutral interest rate should be lower than current levels, the Fed should remain cautious going forward. Bowman, on the other hand, took a more dovish stance, warning that the Fed should act decisively to avoid falling behind the economic curve. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
The accounting of one of those countries goes to hell, then obviously it affects their trading partner across the ocean because they're doing business. There's only one banking system in the world because the dollar is the reserve currency. There's two sides. That's a double-edged sword. In a reserve currency system, you get to export your inflation, but then when that stops, then all that exported inflation has to go back to the source. It doesn't disappear. It just moves. Right? All the inflation that has been created since the dollar became the reserve currency is all still there. Debt from the 1950s and 60s, it's all still there. Why? Because it has to be rolled over. It can never be extinguished because we're not on a gold standard. There's no debt can be extinguished. This is what Keith Weiner talks about a lot. That without gold as the money or as the statutory money, I know it is money. I know naturally it is, and it still is. But without gold as the final extinguisher of debt, debt can only be rolled over. You're forcing yourself into a Ponzi scheme. There's nothing else you can do. So all the debt from the 1930s, 40s, 50s, ever since the dollar and gold were no longer convertible, it's all still there. It's in the form of bank reserves just rolled over decade after decade after decade, and it's all going away. And it goes away when it gets devalued against real money, which is gold. And then all those trillions of dollars of debt held by every country, all the trading partners with the dollar at its base. It's all one banking system controlled by different little central banks all over the world, but basically one banking system with the dollar as the reserve currency and gold underneath the dollar. And then when the dollar falls, all the currencies on top of it fall. And the entire banking system of the entire world that has now the dollar as the reserve currency, they all fall, everything. Yeah. And what exporting inflation does is it delays the inflation. When I say inflation here, I mean rising consumer prices. It delays the effect on rising consumer prices because you're exporting all those dollars outside your country, but they're still there. And when they will be sent back because China doesn't use dollars. they use yuan. That's their currency. So they have no direct use for dollars within their country. So then when the dollar is losing value, the best they can do is send it back to the source. And every country will do that at the same time. So yeah, all of the delayed inflation that the United States never experienced all comes to its door in a sudden flood of reversing the whole reserve currency situation has to be reversed. And it's not going to be gradual. It's going to be very sudden.
Silver price rockets from $42 to $46 on short squeeze momentum. Silver has delivered one of its most impressive performances of 2025, with prices rocketing from $42 to $46 in just 7 trading days. This sharp move caught many traders off guard and demonstrates the volatile nature that makes precious metals both exciting and unpredictable for investors. The recent price action shows all the classic signs of a short squeeze in motion. According to analyst Burak, when bearish traders get caught on the wrong side of a breakout, they're forced to buy back their positions at higher prices, which only adds more fuel to the upward momentum. This creates a self-reinforcing cycle where each wave of buying pushes prices even higher, forcing more shorts to capitulate. The speed of this rally has been particularly noteworthy, with silver gaining nearly 10% in such a compressed time frame. This type of aggressive move often indicates that significant structural changes are occurring beneath the surface of the market. Multiple factors have converged to create this perfect storm for silver prices. The primary driver appears to be short squeeze pressure, as traders who bet against the metal were caught off guard by the sudden breakout and forced to cover their positions. This technical factor has been amplified by broader macro demand for safe haven assets as investors seek protection against persistent inflation concerns and currency debasement risks. The current trajectory has silver pointed directly at the $50 psychological barrier, but history shows that short squeezes often lead to volatile corrections once the forced buying subsides. The key for sustained momentum will be whether buyers can maintain control above the $45 level, which would suggest genuine demand rather than just technical covering. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
First of all, I don't want to have only bullion. That makes me nervous because I don't know where to put all of it. I have enough for what I think will get me and my family through the end game. That's all. In a modest way where I'm not going to be ostentatious or anything. I have no desire for that. It would be dangerous and also insensitive, and it's just not my personality to do that. So, where am I going to put anything that I don't need for the end game, for end game needs? I would put it in a company that I know can pay me dividends in a new monetary system. So when I buy a miner, I'm thinking I want to buy a central bank, and then maybe bequeath it to my kids when 10, 20 years from now, when this is all over, and it will definitely be over 10, 20 years from now. I have no doubt about that whatsoever. It's a matter of basic arithmetic. It's not that complicated. I see these articles over and over, they're saying what's the amount of reserves that is ample or appropriate for the banking system. Well, it used to be zero because the repo market wasn't really a big thing. But then once 2008 hit and they had to buy all this dead debt, and then all that dead debt turns into reserves, which they have to keep cycling through to keep the balance sheet big. So you have all this ghost debt that can no longer be paid back, but it lubricates the pipes inside the main aorta of the banking system. So the basic arithmetic goes like this: it's that there's $2.9 trillion being traded every night between banks for reserves in exchange for treasuries, and then you come out and one of the Fed members said, well, I think the appropriate number for reserves is 2.7 trillion. I don't think we're going to hit any problems until 2.7 trillion. But like, I look at that, I'm like, seriously, you're going to like say that in public, 2.7, but then what about the 2.9 trillion that are being traded every night? Like, how does that work? How do you trade $2.9 trillion every night with 2.7 trillion in reserves? This doesn't, the math doesn't add up. There's $200 billion missing. So what do you say to that? Like, either they have no idea what they're talking about, or you can trade more than the amount of reserves in the system every night through some kind of mechanism that I've never heard of and I don't understand. Maybe. I don't think that's going to happen. But the point is that reserves are now like 3 trillion, almost 3 trillion flat, because the Treasury has been raising a bunch of dollars and they get that from bank reserves. And reverse repos are now basically zero. So nothing can come from that box of money back into the bank system. It's pretty much empty. So, when we hit September 30th, which is only 5 days from now, when repo generally spikes for whatever regulatory reason that it doesn't even matter, but it does every quarter end. So we're probably going to have repos above $3 trillion in volume with reserves below that. So what happens is that you have to bid higher for repo cash, higher than they want to control interest rates for. So that's what happened in the repocalypse. That's what I think is going to happen now. If you have more repo trading volume than you have reserves, I mean, there could be a mechanism I just don't know about, some kind of magic money box that exists somewhere that I never heard of, but that's what I think is going to happen.
What do you think of Salente's take? Will gold continue to rise in the fourth quarter of 2025 and beyond? Are we approaching a major top in the global markets? Post in the comment section down below your honest opinion. Subscribe if you have not yet done so. And check this video right here because it's a perfect fit for you, and I'll see you on the other side. Thanks for watching.